Earning from daily trading is impossible, you think? Then Ashwani Gujral's book, How to Make Money in Intraday Trading, will challenge that notion. This book is a roadmap for a professional trader, showing you how to make money daily with discipline, a solid setup, and proper entry-exit strategies, without gambling. In this video, we'll discuss Ashwani Gujral's favorite intraday setups, professional discipline, trading psychology, and the rules every new and experienced trader must follow if they want to win daily. So if you want daily trading to become a skill and an earning system rather than just an experiment, watch this video until the end. Let's begin. Welcome to the real world of trading, where winners play with plans, not luck. Chapter 1, Part 1. If you think trading is only about charts and the language of candles, you only know half the truth. The real game starts where the mind and discipline are tested. Many people think intraday trading is a game of luck. Some days the market is in a good mood and you make great profits, while other days, even when everything is favorable, you lose. But the author says that intraday trading is neither magic nor guesswork. It's a process, a system, and most importantly, a way of thinking. The first chapter talks about the most crucial thing that 90% of traders never understand, the mindset of intraday trading. This is a mindset for a daily game, not just a one-day game. It is connected to your patience, endurance, decision-making ability, and control over greed. The author begins with a very clear warning. If you view trading as gambling, this book is not for you. But if you want to learn it as a profession, if you are ready to improve every day and learn from every mistake, then this is your real beginning. The first truth of intraday trading is that you are playing against time. Here, every minute is important. If you are 2 minutes late, a great opportunity might slip from your hands. This is why an intraday trader must enter the arena every day like a warrior, prepared, alert, and fast. Now the question is quick decision-making enough? No. Speed is only beneficial when it comes with a plan.
Intraday trading without a plan is like running in a jungle without a map. That's why the author teaches that before every trade, 3 things should be clear in your mind: when to enter, when to exit, and most importantly, when to exit if you are wrong. This third point receives the least attention, yet it is the real test of trading. Making money is easy, but few people have the idea of when to accept a loss. The author emphasizes one thing: protect your capital like your life. Because as long as your capital is safe, you can make a new start every day. But if you suffer a big loss due to a one-day mistake, the entire system can collapse. Now let's talk about the mood swings of intraday trading. The market's mood can change every hour. It may be bullish in the morning, slow in the afternoon, and selling as the evening approaches. An intraday trader must be able to recognize this mood. For this, the author teaches you to divide the market into 4 parts. 1. The first 15 minutes, volatility. 2. Up to the first hour, trend indication. 3. Mid-time, slow movement or consolidation. 4. The last hour, profit booking or breakout. Understanding these patterns and matching your strategy with them is crucial. The author talks about a very interesting tool here, the mental reset button. After every trade, whether it's a win or a loss, a mental reset is necessary. If you have made a profit, avoid greed next time. If you have made a loss, get rid of fear next time. Every trade is a new battle, and every battle cannot be fought with old weapons. So, after every trade, it is essential to ask yourself these 3 questions. 1. Did I take the trade according to the rules? 2. Was my decision emotional or system-based? 3. Can I prevent this mistake next time? Now let's talk about the habit of accepting small losses in intraday. The author believes that a trader who cannot tolerate a small loss can never make a big profit. In intraday, loss is a part of the game. The important thing is not to take it personally, but to understand it as a reaction of the system.
That's why he gives a simple mantra to every new trader. Losses should be small and frequent. Profits should be big and infrequent. And survive. That is, when there is a loss, it should be small and happen repeatedly so that you can learn from it. When there is a profit, it should be big. But most importantly, you should always remain in the market. This part doesn't stop here. The author also shares another valuable concept. Every trade is not an isolated decision. It is a part of your thought habits. So when you make a bad trade, it is actually a reflection of your old thinking. If you don't change your mindset, no matter what the system is, the result won't change. And the mindset changes when you honestly question yourself. Analyze your trades every night and move forward with a small lesson every morning. These habits differentiate an intraday trader from a daily earning gambler. Chapter 1, Part 2. To be successful in intraday trading, it is not enough to just know the strategy. The real victory comes when you can completely control your mental state along with the strategy. Now let's talk about the biggest enemy that hides in every intraday trader's mind: FOMO, or the fear of missing out. The market suddenly takes off, and we feel that if we don't enter now, we will miss the opportunity. Due to this fear, many times we enter the middle of a trade without thinking, and that trade either goes the other way or we have to rely on our stop loss. The author calls this situation death by urgency. That is, a decision taken in a hurry that slowly finishes your account. The solution to this is a strict rule: no setup, no trade. If no setup is seen, watch the screen but don't press the button. Not taking a trade is also a trading decision. Now let's talk about the clarity of the trading time frame. An intraday trader has to decide which time frame they are working in: 1 minute, 5 minutes, 15 minutes or 30 minutes. Each time frame gives a different perspective. It may look bullish in 1 minute, but the market may be sideways on the 15-minute chart.
The author teaches us to adopt a specific process to avoid time frame conflict. Large time frame, determine the trend direction. Medium time frame, watch the setup develop. Small time frame, determine the entry and exit time. This multi-time frame approach not only helps you determine the trend, but also helps you make decisions at the right level. Now we come to favorite setups, that is, those chart patterns or indicator signals that work for every trader. The author states that every successful intraday trader has 2 to 3 favorite setups that they work on for years, understand them, and repeatedly trade on them. For example, VWAP bounce, 20 EMA support, breakout with volume spike, first 15-minute candle range breakout. The important thing is not what the setup is, but whether you have verified that setup correctly. Have you back-tested it 100 times? Do you know when that setup fails? Until you have the complete character file of this setup, putting money into it is not out of risk. The author says here that an intraday trader is not a chart artist. He is a setup specialist. You have to understand the nuances of your setup as much as a doctor needs to know about his treatment process. Now let's talk about the difference between scalping and intraday trading. Many people enter and exit on 1 to 2 minute charts in 10 to 20 seconds and consider it intraday trading. The author clarifies that scalping is a different art, where you need ultra-high reflexes, super fast broadband, low brokerage, and a calm mind. But in real intraday trading, there are 1 to 3 trades, the movement is big, and the decisions are taken thoughtfully. On the balance of trading duration and volume, many new traders think that the faster they exit, the safer they will be. But many times, small duration and large quantity together are dangerous. The author suggests that if your goal is to catch a 0.5% to 1% movement in every trade, then balance your position sizing accordingly. For example, if a 1% move is expected in a stock, then cutting it at 0.2% with 10 times the quantity is not a strategy, but it is uncontrolled fear. Catching the trend in the right way and staying in it is the real profit. The author teaches us to adopt a specific process to avoid time frame conflict. Large time frame, determine the trend direction. Medium time frame, watch the setup develop. Small time frame, determine the entry and exit time. This multi-time frame approach not only helps you determine the trend, but also helps you make decisions at the right level. Now we come to favorite setups, that is, those chart patterns or indicator signals that work for every trader. The author states that every successful intraday trader has 2 to 3 favorite setups that they work on for years, understand them, and repeatedly trade on them. For example, VWAP bounce, 20 EMA support, breakout with volume spike, first 15-minute candle range breakout. The important thing is not what the setup is, but whether you have verified that setup correctly. Have you backtested it 100 times? Do you know when that setup fails? Until you have the complete character file of this setup, putting money into it is not out of risk. The author says here that an intraday trader is not a chart artist. He is a setup specialist. You have to understand the nuances of your setup as much as a doctor needs to know about his treatment process. Now let's talk about the difference between scalping and intraday trading. Many people enter and exit on 1 to 2 minute charts in 10 to 20 seconds and consider it intraday trading. The author clarifies that scalping is a different art, where you need ultra-high reflexes, super fast broadband, low brokerage, and a calm mind. But in real intraday trading, there are 1 to 3 trades, the movement is big, and the decisions are taken thoughtfully. On the balance of trading duration and volume, many new traders think that the faster they exit, the safer they will be. But many times, small duration and large quantity together are dangerous. The author suggests that if your goal is to catch a 0.5% to 1% movement in every trade, then balance your position sizing accordingly. For example, if a 1% move is expected in a stock, then cutting it at 0.2% with 10 times the quantity is not a strategy, but it is uncontrolled fear. Catching the trend in the right way and staying in it is the real profit.
Now we come to the final and most important thing: resetting the mind after a loss. The author calls this the loss rebound protocol. After every trade, you should follow a specific process. Don't take the next trade immediately after a loss. Drink a glass of water and sit quietly for 5 minutes. Replay the previous trade and try to understand the reason. Then make the next decision. When you do this without emotion, you get out of mental bias in trading and think like a professional. The author says a correct thing. Intraday trading is 70% psychology, 20% discipline, and 10% strategy. That is, having a system is important, but if you are not mentally prepared, no system will work. This first chapter tries to explain that intraday trading is not a speed game. It is a test of patience. Chapter 2, Part 1. In intraday trading, every morning is a new beginning, but to guide that beginning, a difficult preparation is needed. And this preparation decides whether you will win today or just try. The author says that if you go to the battlefield without a weapon, defeat is certain. Similarly, if you start trading without any pre-market preparation, you are only dependent on luck, not on a professional plan. This chapter begins with preparation before execution. This preparation is divided into 4 parts. 1. Market summary. What is the trend? 2. Sector strength and weakness. Which sectors are active? 3. Nifty, Bank Nifty, and global cues. What is the overall market sentiment? 4. Watch list and alert levels. Which stocks can have action? The author states that a successful intraday trader is one who reads the market for at least an hour before his first trade and does not press the button as soon as the market opens.
Now let's talk about the role of the global market and SGX Nifty. In the morning preparation, it is very important to know what is happening around the world. Did the American market close up? Is the Dow future in green or red? Are Asian markets supporting it? Has there been any big movement in crude, dollar, or bond yields? All these cues give you a broad perspective of which way the market may be biased today, bullish or bearish. Now we come to the index analysis. The author gives a simple rule: never trade a stock against the index trend. If both Nifty and Bank Nifty are weak, then you should refrain from going long on any strong stock, because 90% of stocks move in the direction of their index. The author also talks about the concept of the anchor candle. Pay attention to the first 15-minute candle. If the market breaks the high or low of that candle, it can determine the day's movement. And if it stays sideways within that range all day, then you know that today can be a no-trade day. Now we come to the stock selection process. Stock selection is the most important and most neglected part in intraday. Most people select stocks based only on news or TV tips, which, according to the author, is the biggest mistake. Pay attention to 5 things to choose a good intraday stock. 1. High volume spike. Has the volume suddenly increased? 2. News flow or earnings reaction. Is there any new news in the company? 3. Technical breakout or breakdown zone. Has any clear level been broken on the chart? 4. Future participation. Has there been a quick move in the stock futures? 5. Is strength seen from the pre-market? The gist of this chapter is that professional trading is not just about catching price movements, but it is the art of preparing yourself every day. And the more one prepares, the more they can make winning a habit.
Chapter 3, Part 1. In the world of trading, everyone sees charts, but very few understand them. The real difference is between reading a chart and understanding a chart. The author believes that technical analysis is a language. Just as we understand a language with words and grammar, to understand a chart, we have to know the language of patterns, indicators, and movements. This chapter begins with a very important question. Can you listen to the chart? Because charts speak, but they are heard in silence, not in noise. The author explains technical analysis as a navigation system. Like a GPS, it doesn't tell you where the destination is, but it tells you which way to go at this moment. So, the trader who thinks of technical analysis as a tool for future forecasting is on the wrong path from the beginning. The job of technical analysis is not to predict the future, but to verify probabilities. And the author repeatedly emphasizes volume, volume, volume. Why does a stock go up or down? Because people's emotions are involved in it. Support and resistance levels are those places where these emotions are most visible. Support is a level where most people decide to buy, and resistance is a level where the tendency to sell is high. Both support and resistance levels are filled with emotions, buying, selling, and fear. The author says, support is where fear ends, resistance is where greed ends. When a stock repeatedly bounces up from a specific level, understand that fear is ending there. That is, support is being created. When it repeatedly comes down from a specific high, understand that the limit of greed has been reached. That is the resistance. The strength of a level depends on its repetition. The more a level is tested, the more it becomes strong or weak.
Now we come to the importance of breakouts and breakdowns. The author says that not every breakout is worth buying and not every breakdown is worth selling. Why? Because false breakouts are very common in the market. For this, the author gives a simple rule. If there's a breakout, the volume should also increase. If there's a breakout, the closing should be above the previous high.
If there is a breakout, the market sentiment should also be positive. Going out of a single line is a very hasty decision to call a breakout. Now we talk about the mistake of indicator dependency. Many people think that if the RSI is above 70, they should sell, or if there is an MACD crossover, they should buy. But the author clarifies that indicators are guides, not gods. If you put 7 to 8 indicators on the chart, you will get confused yourself, so keep everything simple. The author's advice is that every trader should choose 2 to 3 reliable tools and gain expertise in them. The gist of this part is, read the chart like a book and understand every cue in the language of feelings, because technical analysis works only when you view it as an expression of human behavior, not as mathematics. Chapter 3, Part 2. The art of looking at charts becomes more brilliant when we see not just the data, but also the story of the chart. Charts never lie, but they don't reveal their truth to everyone. You must get into the habit of seeing that truth. This section begins with a highly important topic, the price-volume relationship. An intraday move is only sustainable when it has the weight of volume. If the price goes up, but volume doesn't increase, it's an indication of weakness. If volume increases during a fall, it signifies panic selling, and taking a long position in such a situation can be suicidal.
The author makes a great analogy. Price is the car, volume is the fuel. Without fuel, a car can't go very far. This means that movement may happen on a chart, but its reliability is confirmed only when volume supports it. Next, let's talk about the power of divergence. Many times the price is making new highs, but indicators like the RSI or MACD show weakness. This is called a bearish divergence, which indicates that the trend is getting tired and a fall may be coming. Similarly, in a bullish divergence, the price is going down, but the indicator is rising, suggesting that the fall may end soon. The author considers divergence in intraday trading a primary warning signal that can alert you to a potential change in time. Now we'll discuss the behavior of moving averages. The author calls the SMA or EMA the easiest way to understand the direction of a trend. He particularly emphasizes the 20 EMA, 50 EMA, and 200 EMA in intraday trading. The rule is simple. If the price is above the 20 EMA and the EMA is pointing upwards, the trend is strong. If the 20 EMA is coming down and the price cannot sustain itself above it, it is a sign of weakness. Crossovers of moving averages are also a significant event. If the 20 EMA crosses the 50 EMA from below, it is a bullish signal. If it crosses from above, it is a bearish signal. But the author warns that moving averages should not be used alone. They should be used with other tools. The summary of this chapter is, technical analysis doesn't give you certainty about the future, but it's a map that tells you where risk is high and where potential is high. A successful intraday trader doesn't just look at that map, but follows it.
Now let's talk about another important topic, which is the breakout retest. Many times, when a stock or index breaks a resistance level, it returns to that level after a while. If it holds that old resistance as support and bounces upwards from there, this is a confirmed breakout. The author calls this a second chance entry and considers it one of the most reliable opportunities, as the emotions are clear here. Those who missed the first opportunity now enter, and those who are in short positions get out as their stop loss is hit. This is why a retest after a breakout is a high probability trade. Your job is to be prepared beforehand whenever a big move comes. The chart is the map that shows you the way, but you have to walk it and think carefully. The gist of this chapter is that while there is depth to technical analysis, you should not get lost in it. Rather, the real art is to understand it simply and use it for your advantage. In trading, just reading charts is not enough. The real test begins when you have to read your own mind, because intraday trading is not a software, but a psychological battle, where every second your emotions can lead you to a right or wrong decision. This chapter starts with a very correct line, because intraday trading is not a software, but a psychological battle. Your biggest enemy is your own reflection, your greed, your fear, your haste. The author says that most people think trading is a technical skill, but in reality, it's an emotional skill. And the person who can control their emotions becomes a long-term player in the market. Now let's talk about the true nature of fear and greed. In intraday trading, these two emotions come to the forefront in their most dangerous forms. Fear makes you exit too early, while greed holds you in until the stop loss is hit. The author presents an important theory here. Profit doesn't speak to you. It's a preservative for exiting. This means it's not important when you entered, at the right time when you exit. This is what determines whether you made or lost money. And this exit decision is not determined by an indicator, but by your mental balance. Now we come to the trap of overtrading. Many times a trade doesn't go well and you take another trade to recover from it, then a third, then a fourth, and this cycle continues. The author calls this the revenge trading loop. Here, you are not pressing the buttons according to the chart, but according to your anger. The solution is to set a daily limit on the maximum number of trades, such as 3 to 5 trades, and no matter what happens after that, no more trades. If you have a loss, it is important to take a 15-minute break before taking the next trade. The author calls this the cooling period discipline, which brings the brain out of emotion and into a professional mode. Now let's talk about impatience. Many traders open a chart and start pressing buttons. Their mind says that something should be done, and this something becomes the biggest enemy of their money. The author gives a great example. Imagine you were a doctor. If you give medicine to every patient who comes without examining them, what will happen? The same happens in trading when you trade just to alleviate boredom without any setup or confirmation. The solution is, before every trade, ask yourself, is this really a setup or just mental restlessness? Connect every trade with a logic so that the mind can be given precedence over the system. Now we come to ego trading. This is a situation where you just don't believe you can be wrong. You thought of a level and the market didn't go in that direction, but you are not ready to give up, and you sit there moving your stop loss. You think, see, the market will listen to me. As long as you don't drop your ego, you can't learn. Because to learn, it is important to admit mistakes, and to admit mistakes, it is important to see the market as bigger than yourself. Now let's talk about discipline drift.
You have created a system, prepared a rule-based approach, but as soon as the market moves a little faster or slower, you break your own rules. The author calls this the rule sabotage syndrome, where the trend, setup, indicators, everything is there, but you betray yourself. The solution is to review your system once before every trade. Create a checklist that will give you a yes or no answer before every trade. For example, is the trend clear? Is volume supporting? Is the stop loss and target set? Are emotions taking precedence? If the answer to any of these is no, then don't press the button. The summary of this section is, as much as technical skill is important, mental discipline is much more so. Growing in trading means looking within yourself, understanding your emotions, and controlling them in time. Chapter 4, Part 2. When you enter the market, you are not just betting with money, but with mental energy as well. Expectations like, if the stop loss is hit, the system has failed, are the biggest cause of a trader's defeat. Because when reality clashes with this, the person either loses confidence or starts changing the system. The author makes it clear here that the first rule of professional trading is not to think, I am a failure, my brain is weak. But the author says that this thought only makes losses bigger. You have to learn that losing is a part of trading, just as a business has some days with less sales. Do not make trading a test of life.
It is a professional activity where both victory and defeat are regular. Along with this, the author takes us on a journey. Have you ever wondered what the identity of a trader is? The author says that a real trader is not one who spends more time on the screen, but one who stays connected to their process. Trading is not your identity, it is a job. You can be a good person even if your trade fails. Now let's talk about attachment to outcome. When you get so attached to a trade that you want it to be successful no matter what, you have made that trade an emotional bond. The author calls this a toxic trade. The way out is to see every trade as a statistical probability. Either it will work or it won't, and in both cases you have to move on to the next opportunity. Now let's talk about the power of mental stop loss. Many times people set SL on the chalk, but when the price reaches there, they think, let me see a little longer. This thinking can wipe out the entire capital. The author repeatedly says that SL is not just a price level, it is a promise you made to yourself. If you have fixed the SL, learn to stick to it. Because more dangerous than the SL being broken is the defeat of your discipline. Similarly, the author teaches us trade detachment. Send every trade into battle like a soldier. If it wins, that's good. If it loses, be ready with the next soldier. But don't get hurt by that defeat yourself. This protects your mental energy. Now let's talk about morning mindset and daily reset. See every trading day as a new opportunity. What happened yesterday should not affect today's decision. The author talks about a technique he calls mind flush. Sit for 5 minutes every morning and flush out all the emotions and decisions from yesterday. Write in your diary what you did right yesterday, what you did wrong, and what you can do differently today. This will keep your mind clear and focused. Now let's talk about peer comparison and social trading toxicity. Many times we see others on social media. Someone is showing a 10% profit, someone a 5 times return, and we think, why can't I do it? The author warns that this comparison is one of the most poisonous habits. In trading, everyone's timing, capital, risk-taking ability, and strategy are different. Making your own decisions based on the results of others can be suicidal. This is why the author says that in trading, everyone's timing, capital, risk-taking ability, and strategy are different. Because trading is a mental game, and the strongest mind survives the longest.